Thanks for clicking. Is Canada's real estate market about to crash?
I don't know.
Clearly that question has been on a lot of people's minds as of late, as rising inflation, high commodity crisis, and an even more hawkish Bank of Canada looks to more forcefully get its hands around our inflation rate. As a result, we've seen a breadth of new predictions going over how far Canada's real estate market could fall when the Bank of Canada continues to raise rates in April. We spoke last week about a new report from Oxford Economics saying that home prices could plunge up to 24%. And now we have two more reports, one from Capital Economics and the other from the Bank of Montreal, which also go over how far Canadian real estate prices could fall in the face of these rate hikes. So what I want to do today is go over these two reports and go over the reasoning for the slowdown of Canada's real estate market. And then I want to go over some real world data as we're starting to see more signs of a market that is already slowing. And then we'll take a look at what to look for next. Speaking of what to look for next, with the end of the month just a few days away, we are expecting to have more real estate data in for the month of March, which should give us a good idea as to whether or not this real estate slowdown has already started. We do have anecdotal evidence, which we'll get to later, but this should give us a much broader picture of what the Canadian real estate market looked like in the month of March. We'll obviously have updates out on that. If you want to get those updates, click like and subscribe. But for now, let's get into these reports. So Capital Economics released a report this week looking at how high interest rates would have to go in order to slow down Canada's housing market. The report argues that in order for interest rates to be the same as 2018, the last time we had the highest level of interest rates in the last 4 years, the average interest rate would have to hit 2.5%. Given that we could be in for another 8 to 10 interest rate hikes over the next year, the report asks whether or not the housing market can withstand a return to pre-pandemic mortgage rates even though prices have risen by more than 50% in the interim. So, can Canadians handle 2018 interest rates with 2022 prices? The report answers a resounding no.
No, I wouldn't. No way.
With that said, Capital Economics does not expect rates to go that high. They expect interest rates to peak around 2%, so 1.5% higher than they are now. And with that 2%, Capital Economics thinks that we should peak at 0% growth over the year. So while they're not predicting a crash, they are predicting a major slowdown, a complete reversal. Not a complete reversal, but a fairly large reversal from the major house price increases that we've seen over the past few years. With that said, 2% is where Capital Economics puts the baseline. Anything over that 2%, and the report argues that we could be in for major price declines. In fact, the report even notes that the Bank of Canada might just be fine with those price declines, as it were prices to go down at least a little bit. That could help with our inflation rate, which with Deputy Kazicki's recent speech, it seems like the Bank of Canada is ultra focused on. So the report is arguing that the Bank of Canada might be more than willing to accept some moderate price declines in Canadian house prices if it gets inflation under control, if it contributes to a lower inflation rate overall.
No, I won't accept that.
And to a certain extent, I think this report makes a lot of sense. If you recall the recent speech by Deputy Governor Sharon Kazicki, Deputy Governor of the Bank of Canada, the Bank of Canada is going to be focused almost primarily solely on fighting this inflation rate, on getting our inflation rate down to that 2% level, eschewing any concerns for a slowing housing market. So this report is essentially saying that the Bank of Canada won't be showing concerns of the housing market in their rate decisions, and as such, we are to expect higher rates in the future. If we don't see higher rates over 2%, we should be kept at that 0% house growth, but we could see price declines if the rate goes above 2%. And the Bank of Montreal, BMO, also released a report this week which largely echoes that of Capital Economics. While the report does acknowledge that a lack of housing supply may have been contributory to price growth in the past few years, it does say that more of a concern was demand driven. So the high price growth in Canada has been largely driven by these lower interest rates over the past few years. BMO also takes aim at real estate investors, noting that their share of the real estate market has increased substantially with these low interest rates over the past few years. The report further notes that with real estate investors representing an increasingly large share of the Canadian housing market, that demand is reliant on investors thinking real estate will continue to go up. Once that sentiment is broken, once real estate investors get the idea that real estate is slowing down, that the writing's on the wall, the canaries in the coal mine,
It's over.
they too will exit the market, greatly reducing demand for Canadian real estate. So for BMO, the slowing housing market is really about decreased demand. Decreased demand from higher interest rates and decreased demand from the exit of these real estate investors that have comprised such a large percentage of the real estate market for the past few years. BMO then goes over what interest rates would need to be in order to slow down the market. Echoing the speech given by Sharon Kazicki, the speech definitely made headlines. BMO argues that anybody that got a mortgage between 2018 until now should be okay as rates rise. It's new home buyers that will have the biggest issue. But the report does note that if rates do rise over 1.75%, if they do go above that 1.75 or 1.25 higher than we are now, then Canada's real estate market could be in for a correction or worse. So Capital Economics says that at 2% we're in for price declines. BMO says at 1.75% we're in for price declines or a major correction or worse. And it's the or worse that probably gets people most worried. With that said, we are seeing more and more signs of a major real estate slowdown in the works already. Global News spoke to a realtor in Toronto who noted that demand is much lower than it once was. The realtor from Toronto listed in the article said that while they had been accustomed to seeing about 100 viewings of new listings in January, new listings now are only garnering about 5 to 6 appointments per week. So that's clearly a big slowdown in the amount of demand for these new listings. And I'm seeing much the same in London and the surrounding area as well, where we're having much more listings than we are sold. More listings than sold, more product on the shelves than there are buyers for that product is the telltale sign of a slowdown. And I think this speaks a lot to the psychology of home buyers. As more and more reports like this come out, as we hear more and more in the media that Canada might just be in for a real estate slowdown, for a real estate correction or a crash, as more and more of these reports come out, buyers are going to be more and more likely to stay out of the market, to wait and see which way the wind blows.
Thanks for that.
And on the opposite side of that, would-be home sellers are also likely to flood into the market, hoping to cash in on the last bit of the market's peak before we see the major slowdown. So that will create more and more supply onto the market at a time when we have slowing demand. Again, telltale signs of a slowdown. With all of that said, we'll have a much better idea of which way that wind is blowing, how many listings versus how many solds we did see in the month of March, which will give us a much better idea if these reports are correct, what effect these interest rates are going to have onto our market, and what the real estate market looks like in the future. And if you want to get those updates, make sure you click, like, and subscribe, and thanks so much for watching.